I would now like to turn to the aspect of liquidity and financial market conditions. In the February monetary policy statement, if you recall, I had mentioned that liquidity conditions were driven by exogenous factors which were likely to correct in the foreseeable future. Liquidity conditions eased during February and March in the wake of increased government spending, Reserve Bank's market operations, and the return leg of US dollar and Indian rupee sale by swap auction, which had been done earlier in 2022. In particular, liquidity situation improved in March with system liquidity turning intermittently surplus in the first half of the month. In these circumstances, the Reserve Bank conducted 14 fine-tuning variable rate repo operations, that is VRRR operations, during February and early March to absorb intermittent surplus liquidity. Anticipating the seasonal tightening of liquidity at end March, the Reserve Bank injected liquidity through variable rate, that is VRR operations, both main and fine-tuning operations. Consequently, the average borrowings under the MSF window moderated. Liquidity conditions have, however, again turned surplus from March 30th, necessitating VRR auctions from 2nd of April. So you would have noticed in the last 2-3 days, we have been conducting more than one VRRR auctions. On 2nd April, then again we did it on 3rd April. So last 2-3 days we have been doing it. And today, as you know, there is a variable rate, there is a, what you call, as per our cycle, we are doing VRR operation for 14 days, a VRRR operation for 14 days. Now, reflecting these liquidity developments, the weighted average call rate, that is WACR, exhibited a softening bias and has hovered near the repo rate since the last policy meeting. In tandem, rates in the collateralized segment of the call money market have also softened. Financial conditions remained conducive as reflected in reduced term spread in the G-Sec market and stable risk premium in the bond market. In the credit market, monetary transmission continues to be work in progress. Looking ahead, the Reserve Bank will remain nimble and flexible in its liquidity management through both main and fine-tuning operations in both repo and reverse repo. We will deploy an appropriate mix of instruments to modulate both frictional and durable liquidity so as to ensure that money market interest rates evolve in an orderly manner that preserves financial stability. The Indian rupee has remained largely range-bound as compared to both its emerging market peers and a few advanced economies during the financial year 2023-24, that is till 31st March last. The Indian rupee was the most stable among major currencies during this period. This is very important. The Indian rupee was the most stable among major currencies during this period. As compared to previous 3 years, the Indian rupee exhibited lowest volatility in 2023-24. The relative stability of the Indian rupee, which I just mentioned, it reflects, I would emphasize, the relative stability of the Indian rupee reflects India's sound macroeconomic fundamentals, financial stability, and improvements in our external position. Turning to financial stability, let me say that latest data as at end December 2023 show that the key indicators of capital and asset quality of scheduled commercial banks continued to be healthy. The financial indicators of non-banking financial companies, that is NBFCs, are also in line with that of the banking system as per the latest data available. Let me emphasize here that banks, NBFCs and other financial entities must continue to give highest priority to quality of governance and adherence to regulatory guidelines. Financial sector players by and large operate with public money, be it of depositors in banks and select NBFCs or investors in bonds and other financial instruments. They should always be mindful of this aspect. The Reserve Bank will continue to constructively engage with financial entities in this regard. It needs to be recognized that financial stability is a joint responsibility of all stakeholders. The Reserve Bank has also been engaging with the regulated entities and various stakeholders for simplifying its regulations and reducing compliance burden. As part of this endeavor, the recommendations of the Regulations Review Authority RRA 2.0 constituted by the Reserve Bank have been largely implemented. The RRA 2.0 has set a new benchmark for meaningful engagement between the regulator and the regulated entities. Moving further in the same direction, internal review groups within RBI were formed in 2023 to rationalize, simplify, and remove obsolete regulations and streamline the reporting mechanism. In pursuance of the recommendations of the RRA 2.0, that is the Regulations Review Authority, which was constituted by the RBI. So in pursuance of the recommendations of the RRA 2.0 and the internal review groups which we constituted in 2023, more than 1,000 circulars have been withdrawn. A master direction for rationalizing and harmonizing supervisory returns has also been issued. The Reserve Bank will continue to follow a consultative approach and undertake review of regulations in line with the evolving financial landscape.